I've been tracking something fascinating over the past year. While everyone's debating stocks versus crypto, the ultra-wealthy are quietly moving capital into assets most people don't even know exist. We're talking about private deals, alternative investments, and strategies that don't make headlines because, frankly, they're not meant to. So today, I'm breaking down exactly what the rich are buying right now, why they're doing it, and how you can potentially access some of these same plays. Let's start with private credit, essentially direct lending funds. As traditional banks have pulled back from certain types of loans due to regulatory pressure, private credit funds have stepped in, and they're locking in yields between 1,000 and 14% right now. What's happening is these funds lend directly to mid-sized companies that can't access traditional bank financing, and in exchange, they're getting higher interest rates plus protective covenants. The returns come from that interest spread, but the risks are real. Defaults can happen. And unlike publicly traded bonds, you can't just sell these positions overnight. Now look, farmland and timberland have become institutional favorites. And the reason is simple. They produce cash yield through crops or timber sales while also serving as an inflation hedge, since food and lumber prices typically rise with inflation. What's interesting is the scarcity factor. They're literally not making more arable land, and global food demand keeps climbing. The wealthy are holding these for decades, not years. For most people, access comes through specialized REITs or farmland funds, but you're paying management fees for that convenience, usually around 12% annually. Then there's fractional blue chip art. And by blue chip, I mean works by artists like Basquiat, Warhol, or Banksy. The wealthy have always used art as a store of wealth because it has low correlation to stocks and bonds. Now, platforms have emerged letting people buy fractional shares of individual pieces, typically starting around $10,000 per investment. The fees can be steep, often 1.5% annually plus a 20% profit share, and you need to understand provenance, authentication, and the fact that selling can take months or even years. But the appeal is clear. It's a non-correlated asset that's historically appreciated over long periods. Let's talk about off-market housing plays, specifically multifamily and build-to-rent single-family funds. The wealthy aren't buying individual rental properties. They're accessing institutional-grade deals through private placements that never hit the public market. These funds are building or acquiring entire communities, generating cash flow from rents while benefiting from depreciation tax shields that can offset a significant portion of income. The reality is interest rates and vacancy risks are the big concerns right now. If rates stay elevated, property values can stagnate, and if the economy softens, vacancy rates climb, crushing cash flow. It's also happening quietly as private equity and venture capital secondaries, essentially buying existing stakes in PE or VC funds at a discount. So with that said, why would someone sell at a discount? Usually it's institutional investors who need liquidity before the fund's natural end date, which can be 10, 12 years out. Buyers get in at maybe 7,085 cents on the dollar and potentially see returns faster since the underlying companies are already more mature. The key is understanding vintage years and how much of a discount you're actually getting. A 2021 vintage tech fund at 70 cents might still be overvalued if the underlying companies were marked at peak valuations. And by the way, don't overlook the boring stuff, short duration treasuries and municipal bond ladders. The wealthy park massive amounts of cash here, not for safety and tax efficiency. Right now, short-term treasuries are yielding around 45%, completely risk-free. Munis offer lower nominal yields, maybe 34%. But for someone in the 37% federal tax bracket, that's equivalent to 67% taxable. A ladder strategy means buying bonds with staggered maturity dates, say 1, 2, 3, 4, and 5 years out. So you always have liquidity coming due while maintaining yield. It's not exciting, but it's how you preserve capital while earning something meaningful. So what's the common thread? Most of these assets require either significant capital, accredited investor status, or both. And they're structured to be held for years, not traded. The wealthy can afford to lock up capital and wait, and they're using these alternatives to diversify away from traditional stocks and bonds. Now look, I'm not saying you need to rush into fractional art or private credit tomorrow, but understanding where institutional money is flowing gives you a roadmap. Start where you can. Maybe that's a farmland REIT. Maybe it's building a treasury ladder. Or maybe it's just recognizing that wealth isn't built chasing the loudest trends. It's built quietly, strategically, and with patience.